Welcome to this deep dive. We're tackling a really great financial question that came in from one of you, basically. I paid off my house. The biggest debt is gone. Do I still need life insurance?
Yeah, and it's a logical question, right? The common wisdom might say, cancel the policy, debt's gone. But we want to look at why financial experts often disagree quite strongly with that.
Okay.
Our mission today really is to shift the focus. It's not just about debt coverage when you're financially secure. It really becomes about, human capital assurance and asset preservation.
Human capital assurance. Okay, Let's unpack that. If the mortgage is paid off, maybe other debts are low too. What exactly is the life insurance protecting then?
It's protecting the economic engine, the income source. Your greatest financial asset usually isn't the house even paid off. It's your human life value, or HLV. Think of it as the present value of all the paychecks you still expect to earn until retirement.
Right, the HLV. But hold on, if I've built up savings, investments, isn't that safety net enough for the family? Why does losing my future income still matter so much?
Well, it matters because savings are, finite. They're usually meant for goals, retirement, college, whatever. Not necessarily designed to replace potentially hundreds of thousands or even millions in lost future earnings. So let's say you're 50, earning a good salary, expecting maybe 15, 17 more years of work. Losing that income stream, that's a huge economic blow to the family's future, even if they're sitting in a lovely debt-free house. So the income replacement part of life insurance, that's still core. It's not just about wiping out a loan.
Okay, that makes sense. Now, here's where I think it gets really interesting, maybe a bit ironic even. If I've done well, accumulated wealth, got this debt-free home, why is that asset potentially vulnerable when I die?
Because death, unfortunately, triggers immediate and mandatory costs, and these need to be paid in cash, liquid money. We're talking mainly about probate and estate administration fees. Crucially, these fees are calculated on the gross value of your estate.
Gross value, so not net value after debts.
Exactly, gross value. That includes the entire market value of your paid-off home, your investments, everything.
Wow, okay, so why can't my family just, use my savings account or sell some stock to cover those fees?
They might be able to eventually, but often not fast enough. And the amounts, they can be significant. Depending on where you live, these costs can easily eat up, say, 4% to 7% of the total estate value, maybe more.
4 to 7%. So if the estate, including the home, is worth $1 million, that could be $40, $50, even $70,000 needed, like right away.
Precisely. That valuable debt-free asset suddenly creates this massive need for immediate liquid cash.
And life insurance.
It delivers that liquidity. Tax-free almost instantly. It means the family isn't forced by the courts or the situation to sell that home or other assets they wanted to keep just to pay the bills to settle the estate.
Okay, so protecting future income, got it. Protecting accumulated assets from estate costs, got it. But you also mention solvency. Risks while we're still living. What insurance features really matter there for someone focused on preserving wealth?
Right. This is key. The focus absolutely has to shift towards living benefits. This isn't just about death anymore. Including riders like critical illness and especially chronic illness coverage, I'd say that becomes almost non-negotiable. Think of it as solvency preservation insurance.
Okay, a chronic illness rider. What specific risk are we guarding against there? What does that actually do?
It protects your accumulated wealth from the absolutely catastrophic potential cost of long-term care. That rider typically pays out cash benefits if you become unable to perform, usually, at least 2 of the 6 activities of daily living, the ADLs.
ADLs, like bathing, dressing, eating.
Exactly. Bathing, dressing, eating, transferring, continence, toileting, basic things.
If you need help with those long-term, the cost can drain everything you've saved. These riders provide cash so you don't have to liquidate your retirement funds or, yes, sell that debt-free home just to pay for care. It preserves your assets for their intended purpose or for your spouse or heirs.
So pulling this all together, what's the big takeaway for you, the listener, who's maybe just paid off that mortgage?
The game changes. Your financial strategy really shifts away from just covering debts. It becomes about asset protection, income continuity, and solvency preservation. So, our recommendation: stop thinking about life insurance as just a cushion for liabilities. Start by calculating your actual human life value. Understand your true economic worth to your family going forward. Then you can think strategically. And let me leave you with a final thought, maybe a bit provocative, that builds on this. Think about this. If your home is your largest asset and it's not easily divisible, how do you ensure things are fair for all your heirs, especially if maybe only one inherits the house? Life insurance can actually work as an estate equalization tool. It provides immediate tax-free cash to the other heirs, the ones not getting the house, ensuring fairness and preserving family harmony. It keeps your legacy intact without forcing a sale, and that is a whole different level of financial planning to consider.